have an interesting stock for you today. I've been asked a lot of questions about this company recently. It was covered by the Wolf of Oakville and given a 3.5-star rating out of 5. He's pretty stingy with those stars, so people thought, this could be a good one. End up 15% year to date, 30% in the past year. I'm going to go talk to you about Pulse Seismic. I'm going to introduce you to the company, talk about the financials, and at the end of the video, give my opinion. The green flags, why I would invest in this company, and the red flags, why I would not invest in this company. You are watching Common Sense Investing. My name is Cameron. Let's go find a great penny stock. Pulse Seismic is saying, look, we want you to focus on the metrics that matter: EBITDA margin, EBITDA, and shareholder free cash flow. Now, they're saying here that they're a data-driven, cash-based business. Their library gives them an average of 77% of EBITDA margin or cash on the last 5-year period. What they're going to do with that cash is grow the library and generate cash returns for shareholders. So that's what they want you to focus on, and that's what they're going to do with their money. And they held true to their word. 2023, where they had outstanding financial results we'll talk about, they returned $23 million, 94% of the free cash flow to the shareholders. They gave a 40-cent dividend per share. By my calculations, that's a little over 18%, and that's today at $2.20. I'm sure it was a lower share price back then. They also repurchased $1.9 million worth of shares, or 1 million shares, at an average price of $1.92. So that's a lot of money coming back to shareholders. In 2023, they had $39.1 million in revenue. They had EBITDA of $30 million. That's huge based on that revenue. $24.8 million of shareholder free cash flow, and then some nice working capital. I can see why the Wolf of Oakville gave them 3.5 stars. This is just beautiful. But before we get too excited, we need to learn a little bit about the company we have built. So again, the numbers are beautiful here, right? So operating costs were only $8.7 million in 2023. They generated positive EBITDA of 78% of revenue, which is fantastic. Free cash flow of 63% of revenue. They explain it down here. They have no capital commitments. So Pulse does not require labor crews or major equipment like most energy service companies. Our growth capital expenditures are discretionary and are 100% aimed at data set acquisitions. So that's how they will grow, and they have no debt. They have a credit facility. They are not using it right now. How are they making these incredible margins and revenue? Well, seismic. We've already talked about that. 2D seismic, 3D seismic, all these different layers of the Earth's surface that I have no idea what this means. Buying up and licensing the seismic data for all this in case somebody needs to do something with it. That's a pretty simple explanation. I'll dig a little deeper than that. Here we go. This explains it a little bit better, right? So they gather seismic data for subsurface exploration. What are they exploring for? Oil and natural gas, helium, lithium, geothermal, carbon capture. It's interesting because some of these are newer, right? So I think originally they were looking at oil and gas, but all of a sudden they have all these new clients coming in from other industries that also want their data. They're using this data for subsurface characterization for oil and gas energy transition exploration to understand the properties of subsurface reservoirs. And when I say they have the data, they have the data. The estimated Canadian 2D seismic market, they own over 97% of that data, right? The estimated Canadian 3D seismic market, they own just under 50%. So they own a large majority of the seismic data in Canada. So their customers are diverse and long-term. In the past, they've mostly been concentrated in Alberta's oil and gas, natural gas, new energy industries. 58% of purchases were generated by major natural oil and gas companies looking for oil and gas in Western Canada. Now for their growth, they're looking at these new energy customers, including those exploring for hydrogen, lithium, geothermal, related resources such as helium, carbon capture, utilization, and storage. Their top 10 customers vary each year as new people come on board, need their data because they're looking for something underground. So I hope that gives you a small idea of what they do because it's important. They buy up seismic data and then they license out that seismic data to different clients as they need it to look for stuff underground. Not that hard. because now we need to go look at some of the numbers. I'm going to get some help from the Wolf of Oakville. Nothing surprising here, right? Balance sheet is amazing. Solid current ratio of 1.65 with deferred revenue removed. They have no debt. It's a nice start. $23.5 million in cash flow generated in 2024, double what they achieved in 2022. How is that double? We need to look at that, right? That's a massive number. How do you double your free cash flow? Well, they more than doubled a lot of things. Like here, we're just looking at 3 months ended December 31st, and their revenue went from 2.4 million in the quarter to 16.8 million. They actually went from a net loss of almost 2 million to a net positive here of $8.3 million, almost no cash, to $7 million of cash generated in the period. This is the tale of two different companies. Like, what's going on here? Aha. This tells the story, right? And this is fascinating. This is interesting. This really isn't a green flag or a red flag. I just want people to understand. Look at their sales. It's lumpy. It's not just lumpy like quarter to quarter, like some companies as they grow. It's lumpy from year to year. It all depends on how many people need their data. If they get years where there's not a lot of exploration where they have their data, they're simply not going to get any revenue. There's no consistency to it. So it goes up, down, up, down, up, down, depending on where exploration is needed. 2023, as fantastic as it has been for Pulse Seismic shareholders, wasn't even their best years. They had better years in 2021. They had a better year in 2017, and they had a almost comparable year here in 2014. So it seems like every 3 years or so, they have one of these mega years, and then after that, it goes down for a while. Now, that's not saying it's going to happen this time, because one of the interesting things for me is from 2014 to 2021, this was a massive bear market in oil and gas, right? A lot of companies struggled, bad times. Everybody was keeping the belt pretty tight with their spending, and there wasn't tons of exploration. So I have to wonder a little bit, if you're looking at this slide, it's kind of bearish because I don't like the lumpiness, but at the same time, it's kind of bullish, because you have to wonder if 2021 to 2023, with the price of oil these days, with the exploration for all these different things like helium and lithium that we need for the electrification, is this more consistently up for Pulse Seismic in the future? I don't know. Or maybe not consistently up, but I mean, if they're willing to pay those dividends of 18% every time they have a year like that, how many years in the future are we going to get more of these years, right? What if they have another big year in 2024, another big year in 2025? And this slide really shows the opportunity here, right? The gold is share purchases, the blue is dividends. Look at how much they gave back to shareholders in 2023. This is a ton. And the reason that they were able to do that probably is because they had such a good year in 2021, probably fixed their balance sheet. Now they're left with no debt and nothing but, shareholders to spend money on. So the real opportunity here could be, do they have another good year in 2024, 2025, 2026? All of a sudden, these massive dividends and share buybacks will really start adding up for shareholders. I mean, no surprise here, right? If you like a good capital structured company, shares outstanding at the end of the year, down, 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 down. Income statement from the Wolf of Oakville. Pulse was an EBITDA generating juggernaut in 2023 after losing 8.1 on the net earnings line in 2022. So they lost money in 2022 and they're considered a juggernaut in 2023. That's fantastic, but at least now you understand why. Really fascinating final take from the Wolf of Oakville here. Overall, giving them 3.5 stars. Share price has jumped around over the past 20 years. Their previous all-time high was $3.40 Canadian. The revenue bounces around, which is bound to give investors some hesitation. I agree with this, right? He says there's good reason for it. He says that easily, these earnings would be 4-star financials, but deducting half a star here due to unpredictable historical revenue figures. Completely understandable. I completely agree. So what are my final thoughts? What are the rewards of investing with Pulse Seismic? What are the risks of investing with Pulse Seismic? This is their share price from 2014. I think this is both a reward and a risk, right? It will give your average investor a heart attack Basically, they're still not up to the same levels that they were at in 2017, 2014. Their share price is still down, 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 down. That's concerning, right? If you like to see that consistent line up, if you like to see steady growth in share price and you're not hoping for share buybacks or dividends, then this is not something that you enjoy. However, in saying that, you have to keep in mind that the past 7 years up until COVID was a huge bear market for oil and gas. So I do have to wonder if share price can continue to go up in the future. Price of oil is holding pretty firm, right? Are they going to have more good future years? Can they get that share price back up to those 2014 levels? Also, a risk and a reward is what are they going to do this year? Right? It's really difficult to buy right now and you don't know what's happening in 2024. You could be buying at a high, you could be buying at a low. We don't know. However, at least for the moment, Pulse Seismic is saying that they are experiencing a solid start to 2024, generating 8.3 million of revenue as of February 15th. So $8.3 million in revenue by February 15th puts them on track for about 16.6 million for the quarter, which basically repeats their end of the year 3-month December 31st earnings here. So they're going to have another good quarter coming up. If you are interested in this company, you need to go read their MD&A, their management discussion and analysis. They have all sorts of conversation where they talk about the future of this company. However, they will say that industry conditions do not provide visibility. So you need to read what they say. You need to go look at the industry yourself and make your own decision. That's a tough thing to do for some people. They like getting told what to do. They like getting told what the future is going to be for a stock that they own. You will not get that with Pulse Seismic. But what you do get is a chance for another year of 18, 20% dividends, share buybacks, and all kinds of other good things for this company, for this stock. It's interesting to me. This is a very, very, very interesting company I'm going to put on my watch list and continue to do my due diligence on. I want you to do the same. Thank you for watching. You've been watching Common Sense Investing. I appreciate your time.